So today we'll be covering with our FAPS session, the last for this academic year with the FAPS unit, which is the financial accounting preparing statements to do with incomplete records. So when we're looking into a business, the businesses need to have records for at least 5 years plus the current year for the purpose of accounting. Most of the time, companies will retain most of the records without any problems because they'll have organized means to retain all the business records or most of the business records, which is important for their record keeping. But when you're going to be an accountant or a bookkeeper, you also have to consider you may see some sole traders or partnerships where you may have to do the accounting for them, but they may not have every detail you require to complete their accounting records. It's because one, they didn't have the mean to restore, like save all their details, or they simply become careless, lost some of the details along the time they have got it and the time they get to the accounting filing period, and they haven't got all the necessary requirement. So when it comes to incomplete record, what we will be doing, we will be something called a reverse engineering of your numbers, because you normally will have the end products, whatever the details we now have at the moment, and we have to trace that back to find out what initially happened in the past. So that means we're going to go in reverse in time. But not all of the records are like that way. Some of the records you'll be able to do it. Some of the records you just have to do the conventional way. So we'll see some examples as we go along. So for example, now to find what has changed through the time, we have 3 different methods which will help you to understand and to identify what are the missing information. The first method is going to be something called the net asset method. Next one is going to be with the control accounts. Third one is we can use it a concept called margins and markups. So all these 3 concepts will work to find anything missing from past, and then we'll be able to attain any information we require to complete our financial statements. Of course, you need all this information to find what can go in your profit and loss statement, and then what else can go in your statement of financial position. So let's see here, for example, here, what is the net assets method? So as you guys are aware, what is the meaning of net assets? So let's rephrase it now, how I'm going to get to it. So let's see, this is a good example of it. The net assets of a business at the start of the year is £14,600. At the end of the year, the net assets was 17,300. So what happened to your net asset has gone slightly up, not slightly, it's by £2,900. During the year, the owner has paid £2,000 of additional capital, and also they have withdrew £10,000 for the business for living expenses. So how to find the profit for the business? This way, what we can do. So the first thing is to understand what the accounting equation look like. So if you look at an accounting equation, this is your accounting equation. You have capital will be equal to asset minus liabilities. Remember, that is your accounting equation. In that case, if you minus the liabilities from the assets, what we will get, it's what we call the net assets. What is the net assets? Is your capital. According to this, net assets is all your assets minus all your liabilities. Remember, when you're doing your statement of financial position, this is what you've done. So if I'm going to look at it here, the net asset method means the increase in net asset will be equal to, so if in case the net asset from particular situation, if that has increased, that could be only down to 3 factors. All these 3 factors are, we either have new capital injected by the owner into the business, or you retain a new profit, you earned a new profit in that financial period, minus any drawings. This is the formula you have to remember here. This is the only reason your net asset could have increased. If there is no new capital and there is no new drawings, your net assets can be ascertained by the profit earned by the business. Why? The profit will increase the net assets, because in that way your capital is also going to increase the same way. So let's say here, if I'm going to substitute these numbers in this scenario into this formula. So the net asset increase is how much? Is 17,300 minus 14,600. It's going to be 2,700. That will be equal to 2,000 pounds capital plus profit minus 10,000 pounds, which is the drawings there. So if you redraft this mathematical equation, that means you keep the profit one side and move all the monetary figures to the other side, you will get the figure of profit of 10,700 pounds. We can prove it by using the calculator. Let's see the calculator. I'm going to get a trusted calculator out. So the calculator will say to me, initially what we have, 17,300 minus 14,600 plus 10,000, which is the drawings, which is going to the opposite side, that will become a positive number, minus 2,000 pounds capital. That means the new or the profit figure for that period is going to be 10,700 pounds. Okay, so this is one method of calculating. The next method is by the control accounts. Let's look at the control accounts, for example. So they have given you here this one. During the year ended on 31st of March 2019, a business had the following balances on the purchase ledger control account, or another name for payable ledger control account. The payment made to the suppliers for the year end were 167,224 made from the bank account and 430 pounds from the till. So what do you now, how I know this information, people being asked me. So this could have been found out with whatever we had the financial statement last period, and this information could have been found from the ledger accounts. You normally have a ledger accounts there. You'll be able to find the ledger for your payables, payable ledger. You'll be able to find this is the balance we had, and we'll be able to find this one from the bank account, and this one we could find from the till receipts. You probably can create a till receipt when you make a payment, same as you're receiving money, and this one could be finding from the bank statement. All they want you to find out how much is the purchase, how much I spent on purchases, because the business failed to record all the transactions in the book. Maybe they lost some of the purchase invoices. So what we need to do is find the missing purchase figure. So let's put that in account. We put PLCA, initial balance, carry brought down from the beginning of the year. It is going to be 38,450 pounds. Bank payment, which will go on the credit side, which will reduce the amount. Cash payment will be that much. And then also we have found what is the balance brought down on the next period. So if I done this now, I can simply move this number to find the purchase by putting the balance carried down figure here. That means the balance brought down will become a balance carried on. Can you see here? I'm going reverse. Normally I work my way down. This time I'm going to work my way upwards. So this way, the total, I'll be able to find out this is the same number on both sides, and difference between that total minus the balance brought down will give us the purchases figure. Can you see that purchases figure? It's 173,029 pounds. Can you see here how I worked my way from down to up for the missing information there to find the purchases figure? So this is the control accounts method. So now let's look at the next example. The next example is to use the concept of margins and markups. This one, the students do tend to have a bit of a confusion about what is what. Which one I'm going to think when I'm going to have this particular concept and that particular concept. So for me, I need to consider those two options. Easy way to remember, think about which one is 100%. So when it comes to margin, the 100% is going to be your sales revenue. This, if I consider, has the whole circle there, that is the 100% margin. It's going to be a part of that sales revenue. So if I'm going to look at here, the profit margin here, that will be as a part of sales revenue. So if I say there is a 30% margin, that way we know the profit is 30% and cost of sale is 70%, which will automatically accumulate together to give you the sales revenue at 100%. Okay, so sales revenue is the 100%. But when it comes to markup though, which one is the 100%? So we're going to mark up. So you have to consider the 100% for the markup. It's going to be your cost of sales. And the extra we add on, which is the profit, that profit will be the percentage. So if I'm going to say 40% markup, so that means the cost of sales is 100%, the profit is 40% of that 100%, and the sales revenue will be 140%. Altogether, you add the cost of sales and the profit together. So in this scenario, the cost of sales become the 100%. So please remember, guys, margin, sales revenue 100%. For markup, cost of sales is going to be 100%. Okay, so let's look at a couple of questions on margin and markup. This one from the Kaplan book. You have given the following information regarding relating to Clarence's business for the year ended on 31st of March 2023. Cash paid to the payables were £9,000. Other assets and other liabilities were, they have given you that information there. Markup on cost of goods sold was 20%. Calculate the purchases for the year, calculate the cost of goods sold for the year, and calculate the revenue for the year. So let's look at it one by one. We unwrap this particular question, because what information I have got so far, I have the markup of goods. So let's find out how much the information and how I'm going to find the purchases. How I'm going to do that? I'm going to draw the payable ledger control. So if I'm going to draw the payable ledger control from the previous learning, what we know, if I'm putting on the payable ledger control account, the payable have £2,100 opening balance and the closing balance was £2,600. Remember that £2,600 on the opposite side? Now it will be the closing balance. And if you put the payments amount of £9,000 here, bank will be credit, PLCA will be debit. Please don't ask me how you got that entry, because you should know by level 3 how those things. I'm not going to go into your debt clicks and double entry anymore, because you guys are well past that one. So if I substitute all those numbers, and then I'll find the purchase amount is going to be 9,500. Why? That is the difference between the debit side and the credit side if I have blank in there. So if I'm going to look at it here, 11,600, 11,600, take away the opening balance of 2,100, we have 9,500 purchase. So if I know the purchase, what I also know, there is a formula to find the cost of goods sold. Remember cost of sales, how we find it? Opening inventory plus purchases minus closing inventory is equal to your cost of goods sold or cost of sales. Let's put that second one. Here we go. Opening inventory plus purchases minus closing inventory. So let's put those number here. Opening inventory at the beginning of the year was 1,800 plus purchases, which is 9,500, minus the closing inventory, which is 1,600 at the year end. Take that away. We will have the cost of sale amount for £9,700. So we found the cost of sales figure. Now rephrase it back. What we know about the sales revenue. Sales revenue, it's going to be something we adding on top of your cost of sales. So that means if this is going to be 100%, I'm going to add a 20% profit markup on the cost of goods sold. So let's put that here. I have revenue, since the markup is 20%, cost of sales times 20%, it's going to be equal to 1,940 profit. So this profit now will be tacked on to your cost of sales to find the revenue figure of £11,640. So please remember, guys, this is step by step. First, find the purchases. Then from that information, we'll be able to find the cost of sales. Remember, purchases and cost of sales are two different things. Purchases, what I spend on buying goods this year. Cost of sales is how much it costs me for the products I have sold. That means not every one of my purchases has been sold. Only the ones I had sold will be part of the cost of sales calculation. Okay, so that is a really good example of it. We got one more question here. Sales for the year was £120,000, including VAT at 20%. Gross profit margin is 1/4, means 25%. Opening inventory is £10,000. Closing inventory is £12,000. What is the purchases for the year net of VAT? So if I'm going to do this, I need to calculate the numbers net of VAT on both of it. If I know my sales is £120,000, how much is net of VAT? So if I'm going to look at that here, net of VAT, it's going to be take away 20% or divided by 6 multiplied by 5. So I will be able to find out what was my cost of sales. So let's say here the revenue is £100,000. So if I'm going to say including VAT, take away the VAT, and then you'll get the revenue of £100,000. And we know gross profit margin is 25%, means the profit is £25,000 from there. So if I now find the profit first, and I will be able to find the cost of sales after that. What is the cost of sales will be? Cost of sales will be the 100,000 minus that profit £25,000, which will give me £75,000. So once I find this £75,000, I'll be able to emboss that number into my formula again. Remember the formula: opening inventory plus purchases minus closing inventory is going to be equal to my cost of sales. So let's put that into the equation again. So therefore, if I rearrange the formula, the purchases will be 75,000 minus 10,000 plus 12,000 will give you £77,000. Again, when you get this question, guys, please ensure the VAT should not be part of your calculation. Why? VAT get paid on top of your sales revenue. So when I'm going to do the sales revenue, I need to put the net sales amount in any of my calculation. Okay, so it's good question to do. So let's go into my spreadsheets, and then we'll do some questions here. Let me just come out of it, so otherwise it will hide my mouse pointer otherwise. So there's another good question here. They're saying here sales for the year is £300,000, opening inventory is £20,000, closing inventory is £40,000, purchase for the year is £260,000. So we give all of those information here. They want you to find cost of sales, profit margin, profit markup, gross profit for the year, gross profit markup, or the gross profit margin. Those two numbers never going to be same, because we're going to consider one of the other as the 100%. So let's look at the first formula. First formula, they want you to find out what is the cost of sales. Remember, the cost of sales formula is going to be equal to, it will be saying opening inventory plus purchases minus closing inventory. So in this scenario, if I'm going to do it, I already have the number £20,000 plus £260,000 minus £40,000 closing inventory, which give me £240,000. That is my gross, the cost of sales. If I know that is my cost of sales, what is the gross profit is going to be? Gross profit is going to be £300,000 sales minus the £240,000. It gives me £60,000 profit. So how I found it? It's going to be sales minus cost of sales. That is the formula for that. The next one, they're asking you, what is your gross profit markup? So what I know, the formula for that one, it's going to be the profit divided by cost of sales, because that is 100%, yeah, times 100. So here, if I have that formula, I will say the profit, which is that number, divide by cost of sales, and times that by 100. So if I'm going to see that here, let me change that to percentage. It will give me 25. Because if you notice that here, if that is 100%, your profit is going to be 25% on top of that one. It's marked up. So it is going to be marked on top of that amount there. But on the next scenario, they want you to find the margin. So if I'm going to say to a margin, your 300,000 here, that will be the 100%. So the calculation will be profit divided by sales times 100%. So in this scenario, I have to say this one is going to be equal to that divide by 300,000 and times that by 20%, and it gives me the margin of 60,000 pounds within 300,000 pound sales revenue is only 20%. So can you see the difference between those two numbers? One of them is a margin, this one, and this one is going to be a markup. Both of them are different numbers because we consider cost of sales as my 100% when it comes to markup, sales revenue as my 100% when it comes to my margin. So I have to be very careful how I choose both of them. So let's look at one more question there, and we will be able to move on to do some more very complicated questions later on. So let's say here, James Henry owns a business which sells office stationery. Most of his customers are firms in the area to which he sells on credit terms. Although he does not keep a full set of accounting records. There you go. That's what the problem comes up as, because we do not have all the accounting information. So we'll be able to find this information from the partial data given to us. So what we see here, we have got opening balance, closing balance, opening balance, closing balance, opening balance, closing balance, so and so. We have some numbers at the beginning of the year and some numbers from the end of the year. So we consider this 2025 because we already finished that last year. So we'll be able to think about it, how I'm going to do this number. So they're asking you here, calculate the value of sales. So what I know though, from the information we got here, receipt from customers, payments from suppliers, drawings, and general expenses. What I need to know here, what information I need to find what was the they call the value of sales. Let's do that by drawing a T account. So let's draw a T account here. I'll bring that back here. Second one. Okay, so let's do here RLCA. So let's do RLCA. Let's start with the balance board down at the beginning of the year. Receivable 29,200 pounds, and the balance carried down at the end of the year was 20,400. What I also know, the bank receipts from my credit suppliers, so credit customers, 127,800. So therefore, the number here, that will be my sales figure. Why? Because we're not considering the VAT. They haven't said anything about VAT here. We not have to worry about it. All you need to do is find the number. So here, that plus that number is equal to 148,000, that number, and the difference between this and that number will represent the sales figure. So this one is my sales figure. One of the numbers we have found now. So what we can do with a similar way, we'll be able to find the next information, which is the purchases. So let's say here, I'm going to paste this now. I'm going to say PLCA, but the numbers are all going to be different. So let's find out what is the number. So first thing, we start with the balance board down here. Balance board down. How much is the balance board down in this scenario at the beginning of the year? 20,800 pounds. So hold on. 20,800 pounds. And the balance carried down is going to be 16,000 pounds. And then also what I know, bank figure from PLCA, how much we paid to our suppliers, 82,600 pounds. So let's work out the number here. This is going to be this plus that number. That's going to be equal to that number. No, that's going to be equal to that number. And here, this is going to be my purchases is going to be equal to that minus that number, which is 77,600. So 77,800. But what you notice here, guys, we are doing the calculation in reverse. We were going backwards. We normally worked our way down to find the closing balance. That's what we used to do. But this time we are finding something in the middle there which is not been calculated yet. So they're asking you here, calculate the figures of the general expenses to be shown in the statement of profit and loss for the year ended on 31st of December 2015. So what we have to remember now, we need to think about what are the information we need. What are the information we need? Put what is the information is missing for us. So we have to find out what is the general expenses. So let's see here how I'm going to find the general expenses needs to be shown in my accounting details. So what I need to do, I can draw the bank account. So let's start from the bank account. We'll think about how much is the number it's going to be going there. So let's see here. This is the what amount we paid so far from the bank account. And we also have an accrual of £500 there at the year end. So we need to accrue it. So if I accrue it, what will happen to my general expenses? The general expenses will obviously go up. So in this scenario, the part C is going to be general expenses is going to be equal to that amount plus the £500, because if I'm going to accrue it, I need to pay that information. I have to pay a little bit more. Then it says here, shop fitting depreciated at 10% per year using the straight line method. So what we need to do in this scenario, I need to make sure I consider the accumulated depreciation was what? Those information I need as well. So I need to think about it before I complete my statement of profit or loss here. So let's look at what are the information I know so far. They're asking you to prepare the statement of profit and loss ended on 31st of December 2015. Prepare the statement of financial position as well. So let's say here statement of position, statement of profit and loss. So here I'll say pound signs for both sides here. So say here sales. What is the number we found out? 11,109. Yeah, 119,000 there. So now we have to find the cost of sales. Opening inventory, purchases, closing inventory. So what are the numbers we have now? Opening inventory was at the beginning of the year 25,600. Purchases is going to be 77,800. Closing inventory is going to be 29,800. So if I'm going to have cost of sales, that's going to be equal to that plus that minus that figure, which will give you 73,600 pounds. So my gross profit is going to be equal to that minus that figure, which is going to give you 45,000 pounds and 400. So we have that information now. What else we need to do? We need to also consider other expenses, plus there is something we don't forget, the depreciation charge. What we need to do, the depreciation is going to be charged 10% per year. It cost us 10,000 pounds when we bought it. So that means every year we depreciate £1,000. So here the other expenses. So let's say here general expenses. General expenses, how much is that? It's going to be 21,100. Depreciation charges, it's going to be £1,000. And any other things I need to consider here when you're going to be other expenses wise? I don't see any other expenses there, so that is fine. The total expenses are going to be equal to that plus that figure. Therefore the net profit is going to be equal to the gross profit minus this net profit. Let's say here at the moment is 23,300 pounds. We find the profit and loss statement done now. So let's look at the statement of financial position. So statement of financial position is, we're going to have 3 lines now. So let's say here, what are the first asset we have? Shop fittings. This is the carrying amount. So here shop fittings we had 10,000, 3,000, and 7,000, because we have already got the finishing numbers here anyway. We don't have to make no adjustments. What we also know here, these are the NCAs, non-current assets. So let's say here, statement of financial position. So Control B, Control B. Now, current assets. So let's look at the current assets. What we have. We have receivables. Receivables counting at £20,400. So 20,400. Let's say here I can freeze it. If I freeze the data, so let's go here, view, freeze panes. So that means when I go down, I don't need all of the information. So I can still see the data in the top there. The bank account balance. How much is the bank account we have there? £8,000 is the bank balance. We have cash figures of £1,600. Hold on, I don't need it there. I'll put it here, £1,600. And any other, we have inventories. Inventories valued at £19,800, £29,800. So my net assets are at that amount there. So let's say here, I'll do formula. Let's do a formula. Yeah, those two numbers, four numbers there. 59,800. Now let's look at the current liabilities. Current liabilities we have at the moment, payables. Payables are £16,000. Accruals £500. So therefore my current liabilities will come to a total of equal to this plus that. So that number, we have all the information we have about our current assets and current liabilities. And what is the next one we need to do here in this scenario? We need to think about missing something else anyway. Net assets, net assets, net assets. They haven't given us the capital amount, but it's fine. We'll still be able to find that. Maybe that's what they want us to find. Maybe the capital amount they want us to find. Let's see here. We can find that out. Okay, so here, net current assets. Net current assets going to be this number here when we have equal to that minus that figure is my net current assets. And net assets. Net assets is equal to that plus that. So let's prove it again. With this information also, I'll be able to find out what is my capitals. So let's say here, what is my capital is going to be? The capital is going to be, if I'm going to do an accounting equation here, my assets minus my liabilities. Okay, so in this scenario, this is my carrying amount. So that is going to be my assets, asset, and 1 minus current liabilities there. So that should give me what is my capital position. So the capital position is going to be sum of all of that minus that figure. So the opening capital will be £47,000. So let's prove it here. So here that will be equal to capital at the beginning of the year, which is £47,000. We have drawings. How much is the drawings were? £20,000. And profit for the year. How much is the profit for the year? We calculated a profit of £23,300. So here, £23,300. So my closing capital will be equal to that plus that minus that figure £50,300. Can you see here? Let me unwrap it now. Quickly, data. Let me just quickly change this view. Free spains, unfree spains. Now let's look at the profit and loss and the statement of financial position. My net assets and my closing capital are equal to each other, because this is the number we found out from the profit and loss statement, and the statement of financial position gave you that figure. Can you see here, guys? This is a very long process of calculating. In the exams, I haven't seen a question like this deep, but imagine you get this in your workplace. How would you do it? This is the overview of this question. This question is all about doing that type of reverse accounting to find out the missing information. In this scenario, first we found the sales, then we found the purchase. We use those numbers to identify your sales, and you find the cost of sales. Gross profit is found. Then the further information's been included here to find the net profit. Once you find the net profit, the same information can be populated in my statement of financial position. So if I'm going to go here and look at this statement of financial position, so if I go quickly to this one here, and the statement of profit and loss as well, it does look what we need. It's all been included in there. So we made sure all the information's been added on there, and you'll be able to see how those missing information were critical in finding all the missing data. Therefore, you'll be able to obtain these two important numbers which you need to get at the end of the statement of financial position. So that is a really good example of how this process of incomplete data will be helpful for you. So let me finish this off with some of the margin, the ratios before we move on, because I had one more question. If you have time, we will do it later, okay? But let's finish the ratios. So we're going to look at this question. We already done it. Then interpretation of profitability ratios. What is the meaning of profitability ratios? It's the same what you learned earlier, but we're going to put them in a ratio. Ratio means you compare two figures, this against that figure. A ratio can be this swayed this side or the other side. It does no matter what it is. It helps you to understand how the financial statements can be interpreted. Because when you talk about numbers, the numbers can go in millions, billions. Even in case of big companies, it can go in trillions. But instead of going through the massive numbers, we can change all of the important data into a ratio. It gives a really good understanding of the overall health of a business, the profitability of it, the return of the capital employed. Such an valid tool for us, for anybody working in the finance sector. So for example, here, it based on ability to the business to earn the profit. We look at the profitability ratios as these four. In level 4, as you know, there is a new curriculum is going to be introduced in September this year, and everything is going to be changed there than what we had in the past. We have Dean, one of my esteemed friend and colleague here. He will be hosting another session on Wednesday at 7 o'clock. Feel free to join that session anyway to see what Dean has prepared for us. And I'm pretty much sure most of you will be absolutely ecstatic to hearing all the fun things going to be included in the new qualification. Make sure to put that in your diary there. Join us 7 o'clock on Wednesday evening to Dean's session. Dean's going to go through everything, and hopefully that will be very useful for any students who wants to progress to level 4. And this, the information I'm going to give you now, there's nothing to stop you to go to level 4, because the new curriculum is going to be something you're going to enjoy thoroughly. So here we got the gross profit margin, we have the net profit margin, we have return on capital employed, and expenses over revenue percentage. That means you compare the expense against the revenue. They are the 4 profitability ratios we will come across. Let's look at some exam style questions on ratios. So here they've given you all these numbers there. They want you to find out what is the gross profit margin. So let's look at the gross profit margin. We compare that against the sales revenue. So gross profit 154,680 divide by 635,550 times 100, and then net profit is exactly same, but we use the profit for the year instead. Net profit, or the profit for the year, divide by the sales revenue. And then the third one is the return expenses over revenue. That means your total expenses against the revenue. It's not your cost of sales they are talking about, guys. These are the other expenses, your fixed cost. How the fixed cost going to be compared against your sales revenue. That is the third one. The last one is going to be something you not heard about before. Return on capital employed. What is a capital employed? It's not just the money you put into the business. It's going to be also your non-current liabilities. That means any long-term liabilities you took on. For example, they talk about bank loan there, a bond you have taken, something like that way. Those will go against your business as a non-current liabilities. They will be called as further capital employed, and any return on that one, it's going to be net profit divided by capital employed. It gives you an idea how many years will take you to get your money back. Whatever money you invested, how long it'll take for you to get your money back there. So here, for example, the first scenario, we have 154,680 divided by 635,550 times 100, you have 2434 percentage. The next one is also similar. The third one is also similar. We have the numbers already there. On the last one only, you have to think about it. Your profit is 88,740. Divide by the capital employed. The capital employed in this scenario, it's going to be 146,250 plus 204,600 pounds, which will give you 350,850. Times that by 100, it's 25.29%. So that means for the given capital and your non-current liabilities you employed, you will take 25% return of profit. That means whatever money invested, it takes at least 4 years or nearly 4 years. Okay, so you can get your money back within 4 years of that investment. So that is how ROCE, means return on capital employed, is calculated. And then also ratio calculations are not enough. You also must be able to explain what they mean, what they show, and why they have changed. It could be many reasons behind it. We will discuss that in some questions later on. Okay. For example, here, there is an exam style question there. They have given us two businesses, business A and business B. What happened to the gross profit margin? It has come down from business A to business B, but the net profit margin has improved compared to the business A to business B. So that means there is an underlying reason behind it. So they're asking here, what option is likely for the difference in the gross profit margin? So they're saying here business B pay less to their suppliers of inventory. That's wrong, because your margin is lower. That means they pay more to the inventory. Therefore, cost of sales is higher, should be giving you a lower gross profit margin. So that statement is wrong. Business A charges high price for their goods. Yeah, that could be the same reason behind A returning's very high profit margin. So therefore, that could be a reason behind it. Product A, business A sells more goods than business B. It does not give you the profit margin. The volume, it's not equate to the margin. Why? You could have a very small profit there. So it is no way I can identify that percentage. It's not going to be any related to that one. Percentage is, it's how big of a profit you're getting from there. So the answer B is incorrect. Business B incurs higher shop rental charges, but the shop rental charges will not affect your gross profit margin, because these are the additional cost on top of your cost of sales. So therefore, this could be considered the reason why the gross profit margin is going to be different. The answer is for that one is Second one, business A charges high prices for their good. So therefore, you will have more margin on the profit when you compare to the cost of sales there. Now let's look at the next one. What is the option is likely reason for the difference in the net profit margin? They're saying here the business B pays the shop staff more. So if they pay shop staff more, they should have less profit, but they're not. They are getting more profit than business A. So therefore, they may not pay the business staff more. Business A has a better control over their operating expenses. Wrong, because business A has deteriorating profits. Look at that here. They had 17% less, when here only 6% less. So business A does not have a better control over their operating expenses. Business B negotiated bulk discounts on products purchased from their suppliers. That will not affect your net profit margin. It only affects the gross profit margin because it's your cost of sales they're talking about here. But we eliminated all three options. Let's look at the fourth one. Business A has greater number of shops, so it incurs higher distribution and administration expenses, which makes perfect sense. Why? Your other expenses are higher, therefore it eats into your net profit margin. Therefore, you have a less profit there compared to business B. So the answer is going to be the fourth one. So let's see here quickly. Let me share you the spreadsheet. The spreadsheet here. Yeah, all right. Let's look at the ratios question now. Let's look at it, how we're going to come up to these answers. So let's see. First one here. Calculate the profitability ratios for each of the table below. Indicate whether the ratio is better or worse from the previous year. So we have 2024 and we have 2025. So let's say here gross profit margin. How I'm going to calculate it, guys? It's going to be all percentages, isn't it? So therefore, it's going to be calculated as percentage. I'm going to say this is all percentage. So let's say here, what is the first one? I'm going to consider sales revenue and cost of sales in this scenario, isn't it? So here the profit in this case 140,000 divide by 400,000 my sales. So here the gross profit margin is 35%, but next one is 118,750 divide by 475,000. It gave me 25% return as a gross profit margin. So is it better or worse? If you notice that here on the previous year and to this year, it got worse. Now next one, gross profit markup. So if I'm going to look at the markup, I have to consider this as the part of my cost of sales calculation. This is my 100%. And this is going to be my addition on top of that one. So let's say here, how I'm going to do it, 140,000 divide by 260,000. Oh, sorry, 260,000. I have 54% gross profit markup. On the next scenario, 118,750. Oh, hold on. Why I have a percentage already there? 118,750 divide by 356,250. Why have a percentage already? Or maybe I haven't done the equal sign. Okay, so that is 33%. So what do you think about this one? Did it get better or worse? It got worse as well. Can you notice this one is the third of it and this one is almost more than half of it. So therefore, my gross profit has also come down comparing to the previous years. Sales against your expenses query. So let's say the expenses here 80,000 divide by 400,000 is your sales, is 20% there. Now let's look at the next one. On the next scenario, we have expenses 61,750 divided by 475,000 pounds. It gave you 13% sale per sales revenue, expenses against your sales revenue. What do you think about that? It got better, isn't it? Because remember, in this scenario, I have less expenses comparing to my sales revenue. So in this first two, the both ratios deteriorated, but in this scenario, I have a better control of my other expenses. Last year I had £80,000 and this year I had £61,750 comparing to what was the number I having there earlier. So what is that now? Let's look at that here. Next one is not that part. The last one is going to be net profit margin. So let's look at the net profit margin here. Net profit margin is going to be equal to, the net profit is £60,000 divide by sales revenue 400,000. I have 15% net profit margin there. On the next scenario, I have equal to £57,000 divide by £475,000. So what is happening here? I have 12% net profit margin. What happened to that again? It got worse. It got worse because I have received less profit comparing to the previous year. Even though, if I'm going to look at it, I have managed to control some of my expenses, my cost of sales was gradually very up there because it ate into my gross profit margin. And then because of that, it has still allowed you to not retain much of the profit, because from 25 to 33% to 12% here, 35, 54 to 15%. Either way, you're looking at it, it got worse. But let's look at the return on capital employed. So let's look at that. What is the profit we had here? £60,000 divide by return on capital employed, which is your 500,000, 12% there. On the next scenario, we have £57,000 and divide by £50,000 return on capital employed. It is 11%. Again, it got worse. So it's going to take me more time to enjoy the return on the capital I have employed. Even though it's only 1%, that is still going to be matter for the people who's going to look at the ratio there, because I mean, it takes longer for you to get your investment back there. Now, let's look at some of the more structured wordy questions now. Let's see here. All right, this one, gross profit margin. Identify whether this following scenarios would increase or decrease gross profit margin. Sales revenue over the year remained stable, but the cost has increased. What will happen to your gross profit? Sales not change, your cost has increased. What will happen to your gross profit? It is going to decrease, isn't it? Your sales does not change means you start going to lose some of the profits. So therefore, your margin is going to come down. So that is going to be a decrease. Sales revenue and the cost both decrease, but the cost by a greater proportion. So you have those two numbers here. You have cost, you have sales revenue, and you have the cost. But they both come down, but the cost comes down by a greater degree. So therefore, you look at that, this one coming down, but this one coming down a bit faster. So what happened to the margin here? Between those two, the margin is going to increase. There is a change in sales mix, which results in higher proportion of more profitable products being sold in the current year. So when they say here, more profitable products are sold, what is that meaning for you? I have increasing gross profit margin. And the last one is, which one of the following transaction would result? Now, hold on. The business won a new trade discount with key suppliers. So when you get a key, trade discount, what will happen? The trade discount will affect your cost of sales, you reckon? Yes. So therefore, I'm going to have less cost. If I got less cost, what will happen to my gross profit? It's going to increase. So the first scenario is going to be decrease, and every other way, my gross profit margin will obviously increase. Now, ROCE question here, they're saying, which one of the following transaction would result in increase in capital employed? Selling inventories at profit, writing off irrecoverable debt, paying payables in cash, increasing bank overdraft to purchase a non-current asset. So if I'm going to talk about that here, which one will result in increase in capital employed? So if I'm going to sell my inventories on profit, what will happen to my overall gross profit? My gross profit is going to increase. My net profit is going to increase. If my net profit is going to increase, whatever the denominator, numerator I have there underneath, it does not matter. The ratio is going to go up. If my result in more profit, that is going to result in more return on my capital. So therefore, A is definitely going to be fine. What will happen to my irrecoverable debt? When I do irrecoverable debt, I write it out. What will happen to my profit? Profit comes down. If that comes down, return on capital employees, it will come down. Paying a payable in cash. So what will happen to that one? It makes no much of a difference there. When you pay cash or by credit, your profit is still will be affected nonetheless. So therefore, it will not increase it. Increasing bankers overdraft to purchase non-current asset. Bankers overdraft is not a non-current asset. It is a non-current liability. It is going to be a short-term liability. It will not affect the number underneath there. So this will not result in an increase in capital employed. It will not change there. So the only answer is going to be A. But now we're going to look at this bigger question. I even don't know what is the answer. I need to check this because I saw this question. I thought I like it. It looks very big. Let's go through that quickly. Naomi is an accounting apprentice in a small accountancy practice working on several different client accounts. Identify the three features which indicate that Naomi uses professional skepticism when preparing and analyzing financial statement. Because can you remember the guys, whenever we're going to do missing records, incomplete records, we need to be very careful with that as well, because we can't assume everything. We have to be using our professional skepticism when you're going to apply some figures there, because we can't just put, oh yeah, just put that randomly. We can't do that. We need to consider what are the implications for doing something incorrect. So let's look at the first one. Naomi knows that closing inventory should be valued at the lower of the cost of the net realizable value. So when she preparing the financial statement, she will ask the client if there's any inventory that has deteriorated or is obsolete or is being sold less than the cost price. Then she makes the correct adjustments to the closing inventory to account for this. This is absolutely important. Why? My closing inventory otherwise will be overstated. If that is overstated, that is going to result in higher profit, and which is obviously not correct there. So we need to make sure we identify the what is that they call again, the inventory valuation concept here. We need to think about what is the IAS rules for the inventory, IAS 2, I think, yeah, and which will allows you to find out, is IAS 20? I can't remember exactly. It is, maybe it's 20. It tells you value the inventory at the lowest of either the cost or the net realizable value. We have to find out whether we have any obsolete or deteriorated inventory there, or anything we're going to sell that for less than the cost price. So in that case, we need to adjust that one. That is a correct usage of that policy. So let's say here, I'll put a tick on it. Naomi has analyzed the profitability ratios from the financial statements of a client and notices that the gross profit ratio has increased from the previous accounting period. She knows that this means that the ratio has improved, but decided to spend time investigating it. Why? To find out what may have caused the gross profit ratio to change. So she knows it has improved, but she decided to spend time to investigate well anyways, to find out what may have caused the gross profit to change. Okay, give me 1 second. This is a very good thing when you go and look at the number there. That number saying to you, we have a higher gross profit ratio, and that gross profit ratio means it could be the business enjoying very successful trade, be probably having more profit for many reasons, but it could also mean there is some information may be missing. So is it prudent for Naomi to investigate it? Yes, I think it's a good option, but let's check whether there may be something there we have to consider before we moving on. So let's look at the next one. Naomi is preparing the accounts for a sole trader. Naomi has heard from the national news that a large customer of the sole trader has gone out of the business. However, the sole trader has not mentioned this to Naomi in their meetings. Naomi decided to make a telephone call to the client for the clarification, as she knows that it would affect the profitability of the sole trader business. So what we need to do here, you have to consider, I need to make a phone call to the client for clarification, as she knows, of course, we're going to have a profitability issue there, because otherwise you have to write it off as a irrecoverable debt. What will happen to my profit? My profit's going to get hit. So I think that might be a really good option about that one. So let's consider this as one of the good things as we need to do, because the question says there, these are the professional skepticism. Skepticism means I need to be kind of a skeptic when I'm making the calls here. So now let's look at that. Naomi always asks, straight away I have a word always. I don't like that one. I don't like those keywords. Always ask the clients to provide information regarding any outstanding bill and payments made in advance, so that she can make the necessary adjustments for accruals and prepayments. So which is not to do with this professional skepticism, I think, but let's consider it might be a better answer there. So let's say the last one. Naomi manager tells her that she needs the depreciation charges for all the non-current assets finalized before the end of today for a specific client, using the agreed depreciation policy of straight line basis for all plant and machinery, and the diminishing value, balance for all vehicles. If it is not possible to do that in time, then just use the straight line method for all assets. Naomi is concerned that this could lead to possible misstatement in the account there. So again, all the statement looking valid to me, but only 3 of them. Maybe I'm not understanding this question carefully. Give me 1 second, please, guys. Let me just verify that quickly. Yeah, bear for a second, please. Let me find out where it is. FAPS. Oh, okay. Different place. Okay, I understand. What does that mean by that skepticism? Give me 1 second. Let me bring that question on the screen again. Share the screen. Okay, the spreadsheet. Okay, so what they say here, identify 3 features which indicates that Naomi uses the skepticism. Skepticism, that means she's not going with the facts. She's going to take her accounting decisions there. So in this scenario, this one, it's not because she's skeptic, because in this scenario, this is a fact. This fact, it is automatically we make the correct adjustment, to the closing inventory. She's not making any skeptic comment there. She's just making sure she's done the right thing there. But in this scenario here, she has calling the customer, where's that, previous account, yeah, skepticism means she is investigating that by herself. She's not relying on the customer to provide that information. Here in this scenario, the skepticism is for me to consider where that information could lead to. So that means there could be something missing there, so I'm good doing the investigation. Therefore, this is not the right one. This is correct. Similarly, for this one also, you are skeptic because the customer they didn't mention this particular scenario in their last meeting. So I am very skeptic whether you have to make the right call. So we are investigating to make sure we do the right thing. That one also similarly to the last one. Can you look at the last one here as well? This one is not skeptical because you're going to be asking the client to provide the information regarding any outstanding bills and payments. This is not the right way of putting it. But on the last scenario, when you're going to do that here, they're saying it's not possible to do that in time. Just use straight line method. So Naomi, she's skeptic because she is considering this option might not work out for me, because in this scenario, a possible misstatement could be shown in the account there. So the skepticism is being exercised in this particular scenario as well. So here, this is not, and these two are not, and the other three are. But again, they could have worded it a bit differently in the exam. If they're ever going to give you, they'll ask you to find one option, not two or three. They'll ask you to one option here. What they mean by this, this is where Natalie has to use, Naomi has to use her own analytical skills there to whether to use the right thing, do the right thing. This is about the skepticism. I need to make sure I investigate it from my point here. Okay, so I'm pretty much done with that, guys, because this one I wanted to do it, but it's only a small question. I just going to leave it for another time, because we have done this very long question anyway. Let me just quickly change it to, yeah, that's right, this long question, which covers a lot of things there. And of course, when it comes to ratios, this is the important part. You need to make sure you know how to calculate those information. So yeah, let me